Good afternoon. Today I will discuss the topic financial economics. Actually, it is under the DSE course, and here I will discuss the specific area under the financial economics, forward and future derivative market. That is, what is forward, what is future in the derivative market. Before starting the core area of forward and future derivative market, let us explain that why it is important in real life. Actually, in the real life, today we are directly or indirectly interested about the financial market, and the financial market helps us different kind of investments, different kind of returns, and etc. So we must have to concentrate rigorously about the derivative market, about the financial market, about the stock market, and some other capital markets. Let us explain one by one that what is financial derivative market. Here, IMF has given a particular definition that financial derivatives are financial instruments that are linked to a specific financial instrument or indicator or commodity, and through which specific financial risks can be traded in financial markets in their own right. That is a standard definition. Rather, I can write the derivative market, the meaning of the derivative market, in such a manner: derivative market. What is this? It is nothing but it derives contract value. It derives contract value depending on some underlying assets. We can delete the term contract value. Later I will explain that what is contract value. Here just remember, it derives value depending on some underlying assets. It is very important term, that underlying assets. What do you mean by underlying assets? Actually, underlying assets indicates different kind of assets. For example, stock, index, other assets like bonds, gold, or other commodity, etc. So, depending on all these, we are agreeing or we are considering some contract between two or multiple parties, and that is nothing but the derivative market in the financial economics or in the financial market. So, derivative market is nothing but, loosely speaking, it derives some values depending on the contract on some underlying assets like stock market, index, stock index, bonds, gold, commodity, and etc. What is the purpose of the derivative market or use of the derivative market? Now, let us explain one by one the use of the derivative market. Use. The use of the derivative market. What is the use? Actually, first use is the risk management. Every investment in the financial market has some risk, and if we want to minimize that risk, we must have to use the derivative market always. Hedging. What is hedging? I will discuss elaborately hedging in my another class, but here for the time being, assume that hedging is nothing but a strategy through which we can minimize the risk. So hedging strategy, derivative market, enter in the derivative market is a very important strategy for hedging in the financial economics or in the financial market, not economics, financial market. Next, arbitrage. What is arbitrage? Actually, before explaining the arbitrage, let us explain there are two markets. One is NSE, National Stock Exchange, and another is BSE, Bombay Stock Exchange. So there are two stock exchanges in our economy. One is National Stock Exchange and another is Bombay Stock Exchange, Indian context. Now, different kind of shares are available. Say SBI are trading in the National Stock Exchange, also in the Bombay Stock Exchange. TCS in the National Stock Exchange, although also in the Bombay Stock Exchange, and so on. Now, the price of SBI, say in the National Stock Exchange, is 250. TCS, say 3150 in a particular date and time. At the same date and time, suppose in BSE, Bombay Stock Exchange, the price is 252 and it is 25155. So there is a difference between these two exchanges. It is 2, difference 2. Here also a difference is there, 5. So if it is possible, I am purchasing some share SBI from National Stock Exchange and then I am selling it in the Bombay Stock Exchange. In that circumstances, I will gain by ₹2. Similarly, in case of TCS, if I purchase from National Stock Exchange and sell in the Bombay Stock Exchange, I will get ₹5 immediately in my account. This kind of trading is known as arbitraging, and this arbitraging indicates that I am buying something from one market and selling something in another market. And in the derivative market, this kind of arbitrage always happens. And the last use of the derivative market is speculation. What is speculation? Actually, speculation means I have some speculation that the market will go up or the market will go down, or the stock will go up or the stock will go down. Depending on that prediction, I can speculate. If I believe that market will go up, I will definitely buy to sell at a higher price, and if the market goes down, I will sell fast and then I will buy to get the difference. Whatever it is, speculation is also an important use of the derivative in India, not only in India, throughout the world. Next, types of derivatives in India. Now, what type of derivatives are available? Different types of derivatives are available. Forward contracts, future contracts, option contracts, swap contracts. Combining all these four, we mainly say the total derivative market in India. In this class, just I will discuss the first two important derivative market, that is the forward contract and the future contract. First, I will explain what is forward contract, what is its importance, what is its characteristics, and then I will explain future contract, and then what are the basic differences between forward and future contract, and which one is more advanced derivative market in the financial market. Okay, let us start with the forward contract. Forward contract actually initially started first in the world to protect the farmers from adverse price movement. Actually, price movement are very serious issue to every trader. Why? Suppose today's price of gold is 5,000 per gram. Now I am not aware, or we are not aware, that after 3 months the price will 5,500 or 4,500. That means price may increase or price may decrease from the present scenario. So we have no idea that whether price will increase or price will decrease. So if I can block the price level at the present moment, in that circumstances, it is quite easy to trade after 3 months. So this is the first reason, or the basic reason, that why forward contract happened throughout the world in the ancient period. Now let us consider an example before drawing the payoff matrix of the forward contract. First, characteristics of the forward contract. Forward contract, I am writing very few characteristics. Number one, two parties are there. Actually, in case of forward contract, only two parties, not more than that. So, basic characteristics of forward contract is two parties will be there. Number two, time bound. Say 3 months, 4 months, 2 months, 1 month, whatever it is, the party will decide, two parties will decide, but time is always bound. One is buyer, another is seller. Always two parties, there should be one buyer and one seller. Always there will be one buyer and one seller. Two buyer, not possible. Two seller, not possible. One buyer, so the opposite party is the seller. It is our assumption. 4. OTC trade. OTC trade. What is OTC? OTC means over the counter. Actually, in case of forward contract, all the trades are OTC trade. OTC means we always trade over the counter. It is not exchange kind trade or regulated trade. Okay? And the settlement. I will explain about the settlement after some time, that what is settlement. Just now remember, settlement in case of forward contract, either cash or physical in nature. Either cash, and last point is the feature of the forward contract. It is cash settlement or physical settlement. Cash or physical. Cash or physical. That means cash settlement or physical settlement. For the time being, remember that cash and physical settlement, I will explain after some time that what is cash settlement and what is physical settlement at all. Okay, so these are the basic features of forward contract. I am repeating again. Two parties are there, not more than two parties. It is time bound, always trading. One is buyer and another is seller, and the trade is OTC kind of trade, over the counter trade, and the settlement is cash settlement or physical settlement. Now let us consider an example of forward market in the real world, that how the forward market or forward derivative market occurs in the real scenario. Suppose there are two parties, X and Y. X is jeweler and Y is gold dealer. That means X is buyer and Y is seller. So two parties are there. X, jeweler party, he is a buyer or she is a buyer, and Y, gold dealer, he is a seller or she is a seller. Y selling gold to X and X buying gold from Y. This is a scenario, this is a situation. Now the deal price, suppose the deal price is 5,000 rupees, 5,000 per gram, and the total deal value, deal amount, not amount actually, rather it is deal. The total deal is 10 kg gold, means at the rate of 5,000 per gram, 10 kg gold Y will sell to X. This is the deal, and the date is suppose 21/2022. On that day, the deal is that at the rate of 5,000 per gram, 10 kg gold Y will sell to X for jewelry making. When they will sell or when X will get the gold? After 3 months. Means 24/2022. That indicates that I am repeating the total scenario again. There are two parties, one is jeweler party, another is gold party. The jeweler party and gold party, they are, one is jeweler, another is gold party. Now the jeweler buyer is the buyer and gold seller, dealer is the seller. The deal is 5,000 per gram, 10 kg gold, Y will sell to X and X will buy from Y. The date of the agreement is 20th January 2022, and the execution date of the agreement, means on which date they will execute the agreement, is after 3 months, 20th April 2022. These are the forward agreement. Now the question is, what will happen after 3 months? After 3 months, we can get three particular scenarios. Which scenario? Three particular scenarios. One by one. Scenario 1. Price of gold increased. That means after 3 months, the price of gold has increased. Now, if the price of gold increases, then what will happen? Let us explain. X. Okay. Assume that price of gold has increased to 5500. So X and Y, who will be benefited from this? Suppose X and Y, X agreed to buy the gold 3 months back at the rate 5,000. That was the contract value. Now, if it is 5500, definitely he will be benefited. The contract was, he will buy the gold from you at the rate 5,000. After 3 months, the gold price has increased to 500. But he will not pay 5500. He will pay only 5,000. That means he will be benefited. On the other hand, Y will be loser. Why? Actually, Y now can sell the gold at the rate 5500. But due to this contract, he is abide by to, or the dealer is abide by to obey the contract, and therefore ready to sell at 5000. Means at the cheaper price he have to sell. So why will be the loser? So in the scenario 1, if price increases at the rate 5500, X will be in profitable situation and the profit amount is 500, and Y will be loss situation and the loss is 500. So this loss is equivalent to the profit of X. That means if price increases after 3 months, the buyer will be benefited and the seller will lose from this deal or from this contract. Let us now consider scenario 2, the opposite scenario. What is that? Suppose the gold price has, scenario 2, price of gold has decreased to 4600. The scenario 2, the price of gold has decreased 4600. So now X and Y, original price $5,000 and 5,000. Original deal price. Now price, current price 4600. So who will be the loser and who will be the gainer? X will be the loser now. At the present, he can buy the gold from the spot market at 4600, but since already agreement was there, he have to pay or she have to pay 5,000. And why? The market value now present is 4600, but getting higher value 500, means the price y will be in profit situation and x in the loss situation. That is the opposite scenario. So market is uncertain and we have no idea that in which direction market will go, and that is the reason that the parties are entering in the contract. Either it may increase or it may decrease, and therefore they are trying to lock the price at a particular time. And if it increases, definitely one party will lose and another party will gain, and if it decreases, the opposite scenario will happen. Scenario 3, obviously no price movement. That means price remains same after 3 months. So if the price remains same after 3 months, what will happen? Price same. If price same, x, y, neither profit nor loss. That means the same situation. Price remains unchanged. So contract does not earn, the contract not providing any profit or loss to a particular party. So scenario 3 is a break-even situation. Win-win situation, no problem. But the scenario 1 and scenario 2 indicates that what will happen. Now let us draw the payoff matrix of x and y, that how we can draw the total scenario. This is profit in the, here we are considering the price of gold 0. This is 5,000. This is the scenario of x. Suppose it is 4600. So when the price is 0, 1, 2 and 4600, means x are losing. X party is losing. So this is the loss situation. And if the price increases more than 5,000, then it is the profit situation. This is the scenario of x and of the party x, only x. Now the scenario of party y. What will be the payoff matrix for y? Just the opposite. I am doing here to compare both the payoff matrix. It is profit 0. This is for y. This is 5,000. When it is 4600, it is profit for y. So it is profit. And when it is more than 5,000, it is the loss situation of y. So just the reverse picture, payoff picture for y, then x. This is the forward contract payoff diagram, and very important diagram in the derivative market, that how the parties are facing profit or loss in the forward financial derivative market. Okay. Now, the risk of the forward market. What are the major risks? Very, very important issues related with the forward market. And we must have to remember all the risk. First one is the liquidity risk. What is liquidity risk? Actually, let us explain. 5,000 rupees per gram gold price. 5,000 rupees per gram, 10 kg gold. So, can you imagine what will be the total price? Near about 5 crore. Near about 5 crore. If you multiply 10 kg and 5,000 rupees per gram, then it will be near about 5 crore. So 5 crore rupee agreement, but there is no particular third party intervention, no regulatory authority. So huge amount of liquidity is required and liquidity risk is there. We must have to be careful when we are entering in the physical forward market. Since belief is definitely there, but still liquidity risk is a serious issue in case of forward market, since the deal value is very high and no organized market is there, no regulatory authority is there. Second is counterparty risk. The example just I have given, two parties X and Y. If price increases, we have observed that X will be in profit and Y in loss. And if price increases, gold price, and if gold price decreases, X will lose and Y will profit. Now the question is, when a particular party will lose, he may not execute the contract in future after 3 months. In that circumstances, the agreement will be cancelled. So counterparty risk is always there, since one party profit means the opposite party loss. So counterparty risk always exists, and if the loser party violates the agreement, cancel the agreement, we have nothing to do. So it is a very important risk of the forward market. Regulatory risk. What is regulatory risk? Actually, in India, stock market, derivative market, mutual fund market, all the markets are regulated by some authority, and one important apex authority is SEBI. But in case of forward market, actually there is no particular regulation, no particular authority, regulatory authority is there. That means in case of forward market, regulatory risk is there, and if any default is happening, any default problem occurs, we have no option to complain to a particular authority. And also, the forward market has no particular rules and regulation. Just two parties are agreeing that we will buy or sell this amount of product, this amount of commodity at the rate of this and this. Just verbal or some unofficial written agreement. No particular regulatory risk is there. Rigidity. What is rigidity? Actually, in the forward market, we always set a time bound, and this time bound is 1 month, maybe 2 months, maybe 3 months, 6 months, whatever it is. But it is quite impossible to execute the agreement before that time. Means, suppose I am entering in a forward contract that on January 20th, January 2022, I am entering the contract that on 20th April 2022, I will send some commodity to a particular party, it is not possible to send that commodity before 20th April. Means 3 months time rigid. We cannot flexible this time. That means the rigidity is a serious concern and risk in case of forward market. Okay. Let us now explain that physical and cash settlement. Actually, very two important terminologies. One is physical settlement related with the derivative market, another is the cash settlement related to the derivative market. All the advanced derivative market, mainly cash settlement derivative market. But some derivative markets are physical settlement derivative market. Now let us explain that what is physical settlement and what is cash settlement. Physical settlement. Physical settlement means suppose the concept is I am agreed to sell some gold to a particular party. In that circumstances, physically I have to send the gold. That means physical settlement indicates that physical commodity will be transported from the seller's point of view to the buyer's point of view. Cash settlement. Here, suppose I have entered in an agreement that I will sell the gold to a particular party. Now, at the date of execution, suppose the price has increased or decreased. Don't send the gold physically. Just send the price difference money in the account to the party. Let us explain the scenario. Suppose 10 kg gold, it is physical settlement. Physically, I have to send, suppose X, 10 kg gold, seller. So, X have to sell this 10 kg gold to Y. X have to sell this 10 kg gold to Y physically. Cash settlement. Suppose the X agreed that the deal price is 5,000, Y agreed the deal price is 5,000. Now in the real scenario, it is 5500, means he will be the beneficial. So rupees 500 is the difference. This 500 rupees profit will be paid by Y to X account. So X will not get the gold physically, rather he or she will get the price difference in your account, and he or she will buy the gold from the spot market, from his nearby market. It is why actually the forward market deal, suppose I have a contract with a particular person who is located in Mumbai or Surat or outside the country. In that circumstances, physical settlement means I have to transport the gold from that particular geographical location. Quality question is there, that whether the gold is pure or not. Second, some risk is there during the transportation. Transportation cost is also there. So different kind of costs is associated with the physical settlement. But in case of cash settlement, just I am getting the difference, either profit or loss, and then I will buy the gold from the spot market, my nearby market. Since I am located in Kolkata, so I will buy from Kolkata market. There is no need to buy from the Mumbai or outside the country from that party. From that particular party, from where our agreement was happening. So it is better to follow the cash settlement instead of physical settlement, and market follow both the settlement, physical settlement as well as cash settlement. Against this backdrop, against this analysis, now we are clear that forward market has some limitations, and these limitations we must have to overcome as much as possible, and this limitation can be overcome if we consider an advanced market that is known as the future contract. What is future contract? Actually, the future contract is nothing but an advancement derivative market of the forward market, and we must have to aware about the future market since at the present moment a large number of investors are investing in the future market. So let us now explain the basic features of the future market. Future market contracts. Future contracts copy the underlying. Means depending on the underlying assets, I have explained that what is underlying assets. Depending on the underlying assets, future contract are copy. It is always standardized contract. What is the meaning of standardized contract? Standardized contract means, suppose standardized contract means, suppose 15 kg deal. 15 kg deal means 15 kg deal. 15 kg deal, in case of standardized contract, it is possible 15.135, 15.250, 15.350, since it is digitally maintained. But in case of forward contract, it is not possible. In case of forward contract, either it is 15.5 or 16 or 17 or 16.5, like that. So in case of standardized contract, we can continue after, or the fractional trade is possible. Future contracts are standardized, and standardized contract is always welcome as compared to the traditional forward contract. These contracts are regulated. Regulated means future contracts are regulated by some authority. Regulated by whom? Regulated by some authority like SEBI, like different kind of other organizations, and etc. Contracts are cash settled. Just I have mentioned that what is the basic difference between the cash settlement and the physical settlement. Future contracts are always cash settled, means it is an advancement than the other contracts. Contracts are time bound. Here also contracts are time bound, but one important feature is that this time has some flexibility. Actually, in the real world, if we consider the future contract, here we can observe that future contracts for 1 month in Indian stock market, 2 months, 3 months. So flexible contracts is there, and it is also flexible that before the time frame I can exit from that contract. So future contract is nothing but an advanced derivative market than the forward derivative market. Let us now explain briefly that what are the basic differences therefore from forward and basic difference between forward and future contract. The first is it is OTC contract, means over the counter contract. Forward contracts are over the counter contract. Two parties are agreeing that we will deal this kind of thing, and then they are decided that. So the basic difference between forward and future contract, it is forward contract, OTC contract. OTC means over the counter contract. Two parties are sitting in a particular scenario that they will buy and sell a particular commodity at an agreed price at a particular date. But in case of future, it is exchange traded. All are determined by the exchange. The parties has only determination that I will enter in the market and I will buy or I will sell, not more than that. The rate, the price, they have no intervention in that market. Forward market is customized. Just I have mentioned, customized means it is 15, it is 16, it is 150, it is 160, like that. But in case of future, it is standardized 1.5, 0.1565, like this. So future market is standardized market. But in the forward market, it is not standardized, rather it is a customized market. Counterparty risk is there in case of forward market. Two parties, one is loser situation, another is the profitable situation. So the profitable party may loser party may not execute the actual agreement, and in that circumstances the total contract may be cancelled. But in case of future contract, no counterparty risk. Huge number of people are participating, so one profit means others loss. You cannot interpret in a straightforward manner. Forward contract not regulated, I have mentioned, and it is regulated exchange traded future contract. So it is definitely an advancement. Forward contract not transferable, but future are transferable and tradable. Means it is tradable. We can trade in the exchange. We can trade daily in the exchange. When I will take a class on the trading issues, that how we can trade future, how we can trade other derivatives like option and etc., then I will explain more extensively that how future contract is tradable. But just now remember that future contract are transferable and tradable, but forward contract are not transferable and not tradable as well. Single time frame forward contract, 3 months or 4 months or 6 months, whatever it is, just single time frame. But in case of forward future contract, multiple time frame. In India context, it is 1 month, 2 months, 3 months. Flexible settlement. Flexible settlement means physical settlement or cash settlement. Both settlement are available in case of forward market, and that is the reason that though it is flexible, but it has some more risk. But in case of future contract, totally it is cash settlement. So the difference clearly indicates that future contract are much more advanced market, derivative market in the real world, and in India context at the present, huge amount of investment are channelizing in the equity market, in the derivative market through future contracts. Some important terminologies. These terminologies are very important in the future contract. Lot size. Actually, before explaining the lot size, let us explain. Suppose we have a share SBI, TCS, HUL, SBI, Bank of India, TCS, Tata Consultancy Services, HUL, Hindustan Unilever Limited, TISCO, Tata Iron and Steel Company, and so on. So many scripts are there. Now, when we buy share in the spot market, we can buy 10 shares of SBI, even 1 shares of SBI, 100 shares of SBI, or 15 shares of SBI. Similarly, TCS, we can buy any amount, any kind of, any quantity. HUL, we can buy any quantity. Tisco, we can buy any quantity. It may be 1 share, it may be 2 share, it may be 20 share, it may be 50 share, it may be 100 share, it may be 1000 share, whatever it is. This is the stock specific buying opportunities. Now, if we consider the future market of SBI, then you can't buy 10 shares of SBI or 1 shares of TCS or 1 share of HUL or Tisco. Here you have to buy a lot. Lot means, suppose the exchange determined that 1 lot equal to 130 SBI share, 100 TCS share, 200 HUL share, 250 Tisco share. So when in the future market you are buying, you have to buy 1 lot. Like when we buy garments, you have to buy in the retail market, you can buy 1 piece, 2 piece. But when we go in the what we can say paikari market, in the here we have to buy 1 dozen, 2 dozen, like that. Here you have to buy 1 lot, means 130 shares at a time. 100 lot. 1 lot means 100 shares at a time. So 1 lot means 100 shares. 1 lot means 130. Now you can say, sir, 1 case of 1 dozen means 12 everywhere. But here it is 130, 100, 200, 250. Why? Actually, it has been decided by the exchange. We have nothing to do. Some calculation is there. It is not possible to explain that calculation here. However, just remember that in the future market you have to buy 1 lot, and the lot of a particular share determined by the exchange, you have nothing to do. And this is known as the lot size. You can buy 2 lot, 3 lot. Suppose 1 lot means 130. So you can buy 5 lot. Means 5 into 130. You are buying 5 into 130. 650 shares of SBI when you are buying 5 lots. Okay, this is lot size. Spot price. What is spot price? The price which you are getting at present. At present, not today. Throughout the day, the price of particular share either increasing or decreasing, or increasing, or again decreasing, again increasing, again decreasing. So the price movement is kind of this: increasing, decreasing, increasing, decreasing, increasing, and some mean value is there. So it is not possible to say that what was the exact price you are buying for today. So the price what you are facing now, that is the spot price. Suppose the National Stock Exchange opens at 9:15 AM and closes at 3:30 PM. In between 9:15 AM and 3:30 PM, suppose at 2 PM, you are facing SBI 1 lot price is 250. 1 lot price. That is your spot price. Suppose another student at 3 PM, SBI price is 253. So this is the spot price for that people. So spot price means at the time, at present, what you are buying at what price. That is the spot price. Okay. contract value. Contract value means the total value of a particular means spot price multiplied by lot size. This is the contract value. Margin. Margin means every future market depends on some margin. Here you use the margin concept. I will give an example to explain that what is margin. Expiry. Future market has some expiry. That is, you can expire the market will expire or the contract will expire in a certain time period. Let us consider an example before concluding our class. Just let us consider one example to explain the important terminologies of the future market. Suppose we are considering a share price SBI. Okay. Now the SBI, suppose the lot size of the SBI decided by exchange 130. Okay. The spot price $460. Today's price. Spot price $460. So contract value equal to 130 into 460 equal to what will happen? 130 into 460. Okay, let us calculate. 130 into 460 means 59,800. Okay, so 59,800 is the contract value. The contract value. Now margin. What is margin? Actually, in case of future market, every investor use the margin concept and they pay the margin money to the broker to enter in the contract. Suppose 15% of the contract equal to margin. That means if you want to trade one lot contract, you have to deposit 15% of that contract value money to the broker. So what is that? 15% of 59800. So what is this? What will be the figure? 15%. Just calculate. It is 8970. So 8970 is nothing but your margin. So just you are paying 8970 to the broker, and the broker will give you the right to trade for 59,800 rupees. This is the concept of margin in the future market. And lastly, hope you understood, and when we take a practical class, you will get more better understanding that how the future market lot size, spot price, contract value, margin are working. And lastly, the expiry. Actually, expiry is the last Thursday of every month. In India, expiry means last Thursday of every month. And you can execute it up to 3 months. That means the contract January, February, March. Suppose if you enter in a contract in the January, it will be a carry forward up to February, March, close. If you think January I will carry forward, continue to February. If you think I will again carry forward, continue to March, but no possibility to carry forward beyond March, close the contract. So, in case of future contract, the contract may be 1 month, 2 months, and 3 months. Last one concept I would like to explain here, that spot and future market. Actually, the spot market means the market from where we are now buying, and future market means the market which is like this. So what is the basic difference? Actually, in case of future market, you can execute up to 3 months, not more than that. And here you can use the margin. But in the spot market, you have to pay all the money and you can hold for a long time, unlimited. That means if suppose you have 50,000 rupees, you can purchase any share, say SBI, with this 50,000 rupees, and the total number of units which you are getting, you can hold for a long time. But in case of future market, if you use this 50,000 rupees, you can buy 50,000 and the margin money 8970. So you will get some particular lot. That lot you can hold for 3 months. Either you can make profit or loss, whatever it is, you must have to exit from the market. These are the basic difference between spot and future market in the real world. Okay, I think all have understood the total derivative market, which today I have started in my first class. I will explain some extensive literature and mathematical derivation depend on this area, particularly financial derivative market, in my next class. Thanks to all for patience here.